Okay, this is going to be a short little video about trusts um, in comparison to just having a will. So, so the question is, what is a trust anyway? So, versus a will. So, a trust is actually an entity that owns assets. Um, Assets basically owned by an entity prior to an individual's death avoid probate. So, in the trusts that we prepare are marital AB trusts or single trusts. So, I'm going to skip down actually here to talk about other entities that own assets. So, we said a trust is an entity, so you can compare that to other entities like a limited liability company. So, a limited liability company is also an entity. Does that mean if a limited liability company owns an asset, that asset avoids probate? Well, yeah, it does actually. So, and what happens with the asset is determined by an operating agreement for an LLC. So, if an operating agreement says that upon the death of the member, the other members will continue operating the LLC, then that's what's going to happen. So there's basically estate planning provisions inside an operating agreement usually. What's another entity that owns an asset? Well, an individual person is an entity like you and I. So we own assets too. The difference is, though, we can die, and as such, if you don't have proper estate planning for the individual, the asset will go through probate. So, what's the value of an entity? So, we'll talk about the three entities. A trust as an entity, a limited liability company as an entity, and an individual of an entity. So, what's the value of an entity? A trust is just a pile of paper until it owns an asset. So, until an asset is retitled as John Smith, trustee of the Smith Family Trust. Just like when we create an LLC. LLC is just a pile of paper until an asset, in other words, a piece of real estate, is retitled. For example, on a case of a piece of real estate, you would retitle the real estate in the form of a deed. And a deed, like a quitclaim deed, would read John Smith as member of the John Smith LLC. And that's how you know that the asset is owned by an LLC. How about an individual? An individual is just a bag of bones whose net worth is zero until there's an asset titled as John Smith. So, like if we own our house, what it says on the deed is something like John Smith, an unmarried man, or John Smith, a married man, etc. So, that's how you can compare the three. So, we'll skip back up here. So, what's an AB trust? So, an A trust and a B trust gets created inside the marital trust once husband or wife dies, which basically is just a paragraph in the trust about trust A and trust B. And the A trust and the B trust are only as good as the assets retitled to them. Again, just a bunch of paragraphs until an asset is retitled to the A trust or the B trust. Why would you ever do that? Well, you'd only retitle assets to the A trust if husband and wife's assets, including life insurance policies and other assets not owned by a trust, exceed the estate tax exemption. And currently that's $5 million per person or $10 million total. So as you can see, no one who really comes to statewide and gets an AB trust would really ever have $10 million. So that wouldn't be the reason that people hire us to do a trust. It's really primarily to avoid probate. But those are the two reasons that an AB trust is generally prepared. Now, there are other trusts out there, but we don't prepare them. So, if you gather that a client's intention is to do anything other than avoid probate or avoid the estate tax exemption by getting a trust, then they are not in the right place and you need to ask them to go get legal advice from an attorney. Some examples of that would be if someone says, well, I want to get this trust because I want to protect my assets against creditors. Well, the trusts that we prepare are not asset protection tools because the trustee still has control over the assets that are owned by the trust. And as such, creditors can attach them even though they're inside the trust. We're not going to tell people that. We're going to say that they need to get legal advice when they say, I'm getting this trust for asset protection. However, there is an asset protection provision paragraph. It's called the spendthrift provision. It's one of the paragraphs in the trust that say if a beneficiary of the trust has creditors that are trying to attach the beneficiary's asset after the client passes away, as long as that asset is held by the trust after the client dies and does not get distributed outside of the trust, the beneficiary and the beneficiary only has asset protection by keeping the asset inside the trust because technically they don't own it yet. The trust still owns that asset. So the creditor can't attach it because the creditor's beef is with the beneficiary, not the trust. That's just a little note information. You can say things like that generally because it is general information about the spendthrift provision. But you would never present that information as if it's specific to the client because it's general in nature. It's specific to everyone who has a trust with a spendthrift provision. So AB trusts we prepare AB trusts because it's quite possible that the $5 million estate tax cap would not be voted upon by the president in the next election or next year that issue, the estate tax limit, comes up. So if for some reason they don't vote to keep the $5 million per person estate tax limit and it reduces back down to the minimum, which is $1 million, most people do have $1 million when they add up all their life insurance policies and their assets outside their trust, and that's a more viable number that people could go over. And so that's why you'd want to keep those paragraphs inside their AB trust document and not delete it. Quite often clients will say, well, why don't you just delete it if it doesn't apply to me? Well, because it might apply to them at some point in their life. You never know. And you don't want to take it out. It doesn't do any harm to them by keeping it in. In fact, nothing's going to happen with those trusts until the survivor in a husband-wife scenario retitles the asset anyway. So there's no point in changing those paragraphs at all. And it's always the AB trust paragraphs that a client asks us to explain. And it doesn't matter how hard you try, they're never going to get it. Well, actually, some people get it when I explain it. If you just say that it's there so that the survivor of the trust, surviving spouse of the trust, doesn't have to pay estate tax, that's really all it's for. We already went through other entities, the value of an entity. So what's the big idea? So the idea behind a trust is to make the individual entity's net worth zero or make the individual hold no assets subject to probate. Because an individual can die and an LLC or trust can't. We never suggest an LLC as a estate planning tool. It really isn't an estate planning tool. It's for liability purposes while you're alive. Now, what you could do is you could put an LLC inside of a trust, so you can make the trust own the LLC. And the way you do that is you make the trust the member of the LLC because the member is the owner. And if you want the LLC to be inside the trust, then the trust would be the sole member of the LLC. And the idea is to transfer assets subject to probate to an entity that cannot die and be subject to probate, i.e. a trust. So the individual in turn does not lose control of the asset during their lifetime because they are the trustee of their trust. And likewise, they're also the member of the LLC. Trusts aren't the only way to avoid probate. An asset with a beneficiary avoids probate even when it's owned by an individual. Transfer on death or payable on death designations on an asset in a perfect world, and I say in a perfect world because we're not in a perfect world, avoids probate even when it's owned by an individual. An asset held in joint tenancy with right of survivorship avoids probate even when it's owned by an individual. Why have a trust when a beneficiary designation is an option? Well, when you transfer your asset to a trust, the individual has 100% confidence that the asset will avoid probate because the trust owns the asset and not the individual when the individual dies. The individual is still the entity that owns the asset at death, which makes probate still a possibility if the beneficiary designations POD and TOD fail because of some unforeseen error. Beneficiary designations are still in control of a third party, i.e. the bank or DMB. If the designation is not properly prepared, the bank or DMV will require probate, and your whole lifetime you thought your assets weren't subject to probate. So the moral of the story is people make mistakes, bank workers, DMV people, and we don't live in a perfect world. So if you want sureties, thanks for watching. Have a great day.